All right, for today's term sheet teardown, we're going to talk about PIK interest rates. Now, just my little disclaimer, this is not legal advice. This is just based on my experience and for entertainment purposes only. But let's talk about PIKs. So I don't mean a PIK like, the shovel and pick. I mean what's called a paid-in-kind interest rate. Now, when you're investing in startups, sometimes you invest in what's called a convertible note or a SAFE. And these instruments are basically debt or act like debt, but they have some upside associated with them that's more like equity. And the idea is that hey, I'm going to loan you some money, and then, at some future date, the money that I loaned you, I don't actually want it back. What I really want is for you to convert it into equity so that I can capture the upside of investing in your company, right? So that's the idea. If you think about it, if I'm giving a company money, they probably don't have a lot of money to pay me back. And if they don't have a lot of money to pay me back, they probably also don't have a lot of money to pay interest. Or at the very minimum, I don't want them paying interest. I don't really want them to pay cash interest on the money I lent to them. Right? I want them to put every single dollar they've got into growth. I want them to grow this business as much as possible. And every dollar should be at hiring engineers, hiring salespeople, spending on marketing, building the business. And so that leads us to this idea of a PIK interest rate. A PIK interest rate is, like I said, it's paid in kind, but rather than being paid in cash, you're paid with more stock. Is generally the way it's considered. So, for example, PIK interest rates, they run anywhere between 5 to 15%. And so the simple math is pretty easy. It's let's say I invest $1 million at a 10% interest rate, and it is a PIK. Then that means that after 1 year, my $1 million, assuming nothing else changes, this is $1 million, this could be a loan, this could be through a safe, whatever it might be, although typically they don't show up in safes. It's really only convertible notes. This $1 million just grew by 10%, so now it's worth $1.1 million, right? And then let's say the company then goes ahead and raises more capital. Maybe they raise at a $9 million valuation. This would be pre-money. And if you don't know what I mean by pre-money, be sure to check out my pre-money video, pre and post money. And so then I take this 1.1 million and I get 10.1 million. And so my ownership percentage in the company is going to be roughly 10.9%. If I didn't have this PIK interest rate, then my ownership would only be 10%. And so I get this extra, 0.9% ownership in the company. Now, why do investors have things like PIKs? Well, one, it is a little bit of a holdover for convertible notes, because a convertible note is just debt, right? So it's this idea that I am effectively lending out my money, or somebody's borrowing or renting my money, and in exchange, they're going to pay me a rental fee for borrowing that money, and that is the interest, right? So that's part of it. And that's also partly why safes get rid of the idea of having an interest rate associated with them, because they're not really debt. They're not really equity either, despite what the founder or the creator of the safe would have you believe otherwise. But nonetheless, a PIK interest rate is all about just providing some incentive to investors for investing through debt in your company. And the reason why investors kind of like PIK interest rates is because you get rewarded, and there's also some incentive tied to push the founder to raise more money sooner. The last thing you really want to do as an investor is invest this money through a convertible note in the company, and then the company takes it and grows and then never really raises more money. In fact, this happened. So there's this company called Teardown, and they were backed by Andreessen Horowitz, and they did this. They raised money in a convertible note. Then they grew and they grew and they grew, and they did really well, and they became cash flow positive. And all of a sudden, they didn't need any more money. And here you had Andreessen Horowitz, and they had invested all of this money in the company. And yeah, they were getting this PIK interest rate, but Teardown just came back and they paid off Andreessen Horowitz. And so even though Teardown had become this fairly successful big business, and Andreessen Horowitz basically just got their money back plus this interest rate. You don't really want that, and so a PIK interest rate can be helpful in terms of at least generating some return, right? Can you imagine if it was a safe and they didn't have a PIK, they wouldn't even have gotten the interest on it. But the other thing is that this interest rate like compounds, right, over time. And so as a founder, like you need to be aware that like, hey, I'm getting diluted by 10% on the cash that's been invested every year that goes by, you know, assuming it's a 10% PIK interest rate. And so there's a little bit of incentive there to stop the clock in terms of this interest rate and convert everybody over into preferred shares or equity in the company. Okay, if you're an entrepreneur, what does this mean? What do PIK interest rates mean? Well, if you're doing convertible note, you're going to probably, in all likelihood, you're going to have some sort of PIK interest rate. Just be aware that like the interest rate is really diluting you over time, right? The benefit is you don't have to pay cash, but you are paying for it in terms of dilution. So keep that in mind. Negotiate something in the 5 to 15% range. You know, I typically see stuff in the like 8 to 10%. It might be a little bit higher in this market, but in general, that feels about right. Which, to be honest, all things considered, is a relatively low interest rate compared to like what it would cost you to go borrow money, assuming you know you were able to borrow money for your startup. It's not really like the point you want to get super hung up on. Although just know that if you come to a VC and you're like, we're willing to pay like 3% or 4% or 5% PIK interest, it's gonna send this like negative red flag to the VC of like, oh, this kind of feels expensive. Even if like the other terms are fine, it's just going to kind of feel a little bit aggressive. And that may not really be the way that you want to come off. Same thing with VCs. If a VC comes to you and they're like 20% PIK interest, right? That's probably not going to rub you the right way and be the kind of person that you really want to negotiate with, work with, partner with, right? So keep that in mind. But in general, like those are the rough interest rates that I tend to see on these things. Anyways, hopefully this term sheet teardown was helpful to you. If it was, check out some of my other term sheet teardowns, like the one where I talk about pro-rata rights and why they matter. Thanks.